Hey there, we're talking about capital coming to agriculture, about the returns, and about what the future looks like for outside money rolling into our industry in this episode of The Business of Agriculture. Attention farmers, want quick answers to your toughest questions? Meet Agvisor Pro, the innovative mobile app designed just for you. Tap into a network of trusted experts and industry professionals right from your phone. Whether you're seeking advice on crop management or the latest equipment, Agvisor Pro connects you with the answers you need to succeed. Best of all, it's free, so download it on iOS or your Android device. Don't miss out on expert insights that can transform your farming experience. Download Agvisor Pro today and start connecting with the knowledge you need to thrive in the field. Hey there, welcome to another fantastic episode of The Business of Agriculture. I got a great one for you today. I'm coming to you from the AgView Solutions Executive Conference. It's for larger scale, business-minded farming operations, and I was a speaker here today. Chris Barron is the person that put this on. He has been on my show a number of times, and I pulled these two guys aside. They were with a company called Fractal. I first came in contact with Fractal. I produced and host the webinar that Haldeman Farm Management and Real Estate Services does. It was a year ago. I had Ben Gordon on with Fractal. Fractal is an investor that partners with farmers on farmland acquisitions, and they're going to talk a little bit about that. But more importantly, we're going to talk about where capital is, where it's coming from, where it's going to. You know, I've often said that there's a lot of very low poultry style returns in production agriculture. Why would outside money even want to come into it? That's one of the things we're going to address. We're going to talk about land ownership. We're going to talk about equipment. We're going to talk about interest rates and whether we need more outside money coming in. Talk about the future and obviously what the whole presidential change and global dynamic is going to do for investment in this space. All that in this fantastic episode of The Business of Agriculture. All right, Ben Gordon, you are with Fractal. You're with Brian Grundtner, and you work for Fractal. I came across you a year or so ago with the Haldeman situation. I just saw you speak. You heard me speak. We have some things that we both agree on. Just kind of give me they always say elevator speech. I don't like people to talk to me in the elevator, so instead of elevator speech, just talk to me where things are when you think about capital agriculture. You're a farm kid from North Dakota, now in the equity markets for all intents and purposes, out in the Bay Area.
Yeah, I mean, I think for us, it's starting with the farm need and then backing into where is there available capital to get into that need. And really, we looked at, if you look at just one of the folks that's here, even at a place like AgView, and they're looking to expand because they have landlords that are, passing on their wealth, or capital intensity is increasing. Banks will go 50% loan to value. Rates are up, just like you said. Like there's a gap that is out there, and that is the gap that we're trying to solve. And so then we had to go figure out, well, is there anyone who's willing to go solve that darn thing? And, I think, as you said, if you look at certain levels, the returns in agriculture aren't that attractive, but there's certain assets and there's certain ways of investing that we think are very attractive. And there's actually a lot of money on the sidelines today.
I'm going to peel right off of that because that's one of the things, Brian, that I have, I've learned more about capital and learned more about money and how investors think. And I guess it's because I'm getting to where I know more people in that era. When you're growing up, a poorer type kid, you don't know investors. Now you know people that are deploying vast sums of money. The first thing is there's more out there than we even realize. There seems to be an absolute, I'm looking out the window behind you at the ocean. There's an ocean of cash. There's an ocean of money. I don't think, my observation, if I had a great thing going in agriculture, great idea, getting the money, I don't think would be that hard. Am I right?
Yeah, I think it's not that hard to find investment dollars into agriculture that are interested in agriculture. I think I would probably look over to my left here and say, where do you think that money is going to come from and be sourced to? I spend most of my time sitting with farmers and talking about the need for capital in their business with what we do here at Fractal.
You're on the farm front. You're out here saying, okay, I farm several thousand acres and I've got a chance to buy 500 acres, whatever that should be, but this is going to string me out pretty hard with my finances, and that's where you come in. So you're out here trying to find a person that needs a partner, an equity partner.
That's right. We're looking for farmers who are also looking to do more than their current financial resources are going to let them do and stay healthy. So you can only go so far with the cash on hand and debt. And there's a lot of good debt partners out there, and you should use debt as the tool it's designed to use. But farmers have always only had two ways to grow, really. Maybe three if your uncle happens to be the dentist in town, but you're raising and saving your own capital cash, your current assets, and then using debt to go out and do that.
Debt partner, by the way, to the person that's listening to this that doesn't consider himself to be financially minded, I always try to make sure we scale it back to, because we don't want anybody to feel excluded here. Debt partner, you mean a lender.
A lender, yes.
A traditional lender, a farm credit,
yeah.
a rural banker,
Yeah.
Maybe even a credit union. All right, so he's out here looking for that. Go back to the question that I asked, Ben. It seems to me that there's an absolute sea of money out there. And I'm not being anyway arrogant or even judging. It's just, I always wondered, oh my God, where does this come from? There's a lot of money looking for somewhere to go.
Yeah, I mean, if you look at the amount of money that we've printed in the last 10, 20, 30 years, it's just seeking different types of return. And I think, when you ask, well, how it's all out there, where does it go? How does that get fixed and matched and all that? Like finding the right match between capital and what it's actually looking for and what to go do with it is a lot harder than people think. But once that problem is unlocked, there are mountains or seas or whatever metaphor you want to use of capital to go in. So on our debt markets, that is why we have such available and cheap debt within a certain box. There's a reason that everyone's at loan to value of roughly 50%, a little less right now. Because if you look at Farmer Mac, our farm credit system, private lenders, they're all going to the same big sea of capital markets. It all kind of is a commodity and it all ends up being the same thing. We're trying to find the next version of that on equity to solve the gap. And in finding that gap, you have to then go compete with other assets. And that comes back to, is this an attractive investment to them? And how do you make it a more attractive investment to that investor while still meeting that farmer need? You got to find that clearing price and that alignment. Otherwise, it's just not going to work.
By the way, you just said something interesting that, again, you got to get a financial mind, which maybe, you had earlier in life than some people, but you've essentially referred to money as a commodity.
It is.
And it is.
I mean, it is a unlimited commodity,
and it's
especially in today's world, right?
And it's an input. For me to grow, to Brian's point, okay, I've got tell me the person that you're looking at and what they say. Yeah, I could borrow this, but it's going to put my ass over a barrel. And that's where the thing comes in, right?
Well, you still need cash. You still need cash to go get debt. So you only have so much working capital. So you can tear that down payment out of your current assets.
Yep.
Or you can take that out of your long-term assets, that equity that is not encumbered by debt right now, that you can't use fully.
Yep.
So employ that asset for your growth more fully.
That's where you are.
That's where we are.
All right, so just real quickly, because I almost wonder if we'll see the fractal model come to more facets of agriculture. I'm guessing you're going to say, yes, it will. But in other words, any other thing I need to buy, any other asset I need to buy, even if it's a depreciating asset, is there going to be something like you're talking about versus debt? But let's talk about how your situation works. Brian, explain to the situation. I'm a farmer. I've got 2,000, it doesn't matter, the number of acres. I've got a chance to go and buy this. My financial position's okay, but buying this new 500 acres, as we've said, is going to really put me over my skis. What do I do?
Sure. You own some farmland already.
Sure.
You have likely have some debt on that farmland, or maybe it's free and clear. It doesn't matter. We're an equity tool, so we're going to come in second to the bank on some land that you own. We're going to invest in a minority position in a piece of ground. We don't own anything. You still have agronomic control, full control. You're going to then take that capital that we invest in that land and go deploy it into your business to grow your net assets, to pick up that new piece of ground. You haven't touched or maybe touched less of your current working capital. This is going to keep you more solvent. This is going to keep you working throughout the year.
So I was going to ask, is that why this is better than debt? Versus me just going to a lender and getting the money, the reason your situation is better is?
I think it comes alongside debt. I think it's less about being better than debt, and it's more about giving the farmer more financial tools in order to grow and maintain those healthy ratios that they need.
So we said that we've got money coming from a lot of sources. Before I get into that, I'm going to ask you about where your money comes from. Who are these people that give you money? But then you go and leverage and do all that, and then I want you to then be prepared to give me an absolute anecdote, illustration, example, without saying the name of a farm, and tell me how it went so that we can say, oh, okay, and see how it goes. And I want it to be one that you've been in partnership with for more than a day. Okay. Before I talk about the money, I've got to talk to you about some money, because you know what? This Business of Agriculture show has to make money for me to justify doing all this work. So anyway, Redox is one of my business partners here. We love those people. 30-year-old company out of Burley, Idaho. Darren Moon started the company in the 90s doing specialty crop, worked his way into turf, and is now doing increasingly broadacre. We're talking about bio-nutrients that can help you get more bang for your buck. You know what? Inputs are expensive. We know that this whole biological space is a wild west, but what about a company that's been around for 30 years that can help you put stuff out there, get more bang for your buck, use less traditional inputs, probably improve your environmental situation, maybe even help you appeal more for a sustainability program? Go to redoxgrows.com to learn more. That's redoxgrows.com. Also, you can check out they have a podcast that I've been on, so go check that out, redoxgrows.com. Where's the money come from? Where does your money come from?
Our money comes from, right today, family offices, high net worth individuals, primarily in the Midwest, because they usually have some connection to agriculture, and our strategy resonates with them because they understand, just because, I mean, both their financial experience and usually they've just driven to a small town or through a small town, that they don't know what to do with that farmland, and they think a farmer is the best manager, which is our strategy. So you're talking Chicago, Minneapolis, and then a little bit of New York. So my average week is take a red eye out to New York, a couple days there, go ask for money, go fundraise, and then back in the Midwest for a couple days in a cab, and then or in the shop, and then back home on Friday, which lends itself to how do you find those win-wins between those two very different but actually somewhat similar business audiences.
Average is always a tough thing when you talk about numbers in terms of dollars. If I said what's the average investment, you might have a hard time, because maybe somebody gave you $50 million and someone else is giving you $50,000. So what's
$3 to $5 million checks are kind of the sweet spot for us right now. But I think the way that capital markets work, like, we're early. We've deployed $10 million. We had a $15.5 million first close on our first vehicle. That will be multiples of that very, very quickly. And I think the thing that people don't realize about capital markets, that's not like, if they've followed ag tech software or their own growth, this thing can go really, really quickly. And so you go from 10 to 50 to 100 to 500 million to $1 billion. It's limited by your ability to prove that you can do that. And with capital, if there's a big need, you can move pretty darn quickly.
You take that money and then you leverage it also. You are using leverage, lended money, borrowed money.
No, today we're not using leverage. We just take the money from the investor, put it into a pool, and then go get assets. We have the ability to go put leverage on it in the back on our side. We haven't used that yet just because of where we're at on interest rates in those markets. But if there's a tool that lowers our cost of capital and is in that win-win, we're going to go do it.
Brian Grundtner, give me an example, a real-life example, a story, an anecdote from where you guys have done this, and why you're convinced this is going to continue to grow because it worked so well.
Yeah, I have a great example. Great Iowa farm we invested in. They buy farms. They had bought a couple farms in that year already, and we had started talking about what else was going to happen that year. And then kind of out of the blue, they had two landlords come to them. And then one of them was moving a piece of ground that they had rented for a long time. They had put a lot of investment in that piece of ground. And there was 3 quarters that were going to come up for sale, and they wanted to figure out how they could move on all 3 of those farms. In order to do that and have the cash position needed to go get the debt that they needed to pick up those 3 core farms for their business, they needed more cash. And so they came to us. We put investments down on a few of their farms, deployed some capital to them in time for them to go turn around and go ahead and close on those 3 farms. And they were able to add those, not only 2 rented pieces of ground that they had farmed for a long time, but a net new quarter section of ground.
Real estate goes down, been let off with it. Let's say I think that farm real estate is overvalued. Let's just say, I'll be kind here, and I'll say 10% across the board. So your investment goes, this land that you just bought, that one example, that's 480 acres. It goes down by 10%. This is $12,000 type dollar ground, probably more. You're talking about a significant hit to the actual balance sheet. Does it bother you?
Not in the long term.
What's your investors?
No.
I would say not in the long term.
Our investors.
When Ben shows up to get the next infusion from the investor group, they say, "Hey, wait a minute, I'm down over here, man."
What's the investor advantage that they have? It's time versus the cash flows that a farm has. And that's where if we can match those up, we can bring that investor advantage alongside that farmer. So our investment periods, we lock the investor up in our fund documents, the legal documents that we sign with them and that are regulated by the SEC for 10 years. Okay. That is the earliest that they go out. Farmer can buy us out at 2 years. You have to have that alignment. Why are they willing to accept that? Well, that's usually 2, maybe 3 commodity cycles. Guess what? Over 2 to 3 commodity cycles, if you look at historical returns, a lot of that volatility comes out. You were giving me a hard time in the presentation that I only talk in longer terms. Well, maybe it's because you could either say a smart or a lazy investor. I'll take lazy and hopefully in the right direction on this, where if I believe that supply and demand is going in that right way, we'll structure a product that meets that farmer need and hits those kind of assumptions that are easier to prove.
I'm looking at my producer Joseph over here, nice young man, and he's laughing. It's because I said, you're talking 25 years. Have you looked at this crowd? There's a good 10% that ain't going to be around here in 25 years. All right, so about the money, the flow into this thing, is it a tough sell or is it an easy sell?
It's a tough sell early because no one's ever done it this way.
Yep.
When I go back home and I describe how we invest, most people look at me and they're kind of like, well, why wouldn't you invest with farmers? Because everyone back home in North Dakota or any rural community that you're in is like, well, of course I know that a farmer's best position, not because of some farmer worship stuff, but because a field is different from another field.
Yes.
And good local management matters.
Yep.
And somebody out in New York, San Francisco, Chicago has no idea what they're doing. So that's common sense to us. However, in normal private equity, they take this whole view of active management. I go in, I'm going to buy this company, I'm going to change it. There's something that needs to be changed. That's the traditional model. That traditional model is built for really big deals. 10, 100 million, billion-dollar deals in the rest of our economy. Mm-hmm. Guess what? We have an ownership structure that was settled with the Homesteading Act. We have a very fragmented land base. Localized ownership is actually a better model, and you can't just treat the ground transactionally because we're dealing with nature. That lends itself more to this minority model that is very different than the traditional way. So even though it might make sense to many of us who grew up in this area, it doesn't make as much sense to finance folks until they start tearing it apart. So you got to tear it apart with them. That's a slow process. These are relationships. But once you get that track record and it makes sense, then the spigots can go a lot wider than what we're used to, because we're used to dealing with nature and low margins, and that growth curve isn't quite as steep. This growth curve is a heck of a lot faster. So it's slow until it's not.
Does this concept proliferate on land or other agricultural assets? You know what? Other people want to be in this space. There's a lot of capital looking for somewhere to go. Some of it's sentimental. It likes agriculture. Does it go to a food processing venture? Does it go to to the machinery, to the stuff that's depreciable? Does it go? Where does this go?
I think you're always going to tie it to an appreciating asset in land, because I think that's where people not only want exposure, but as an investable asset for the farm and like what you're going to own and base your business on. That's where you're going to continue to invest in your business. And just as we talked about before, with automation coming and more robotics and farm consolidation, you are going to need more scale.
What about the other discussion we had, Ben? There's this idea that big money is going to come into agriculture, and you and I can make the case there's a lot of such low returns that it wouldn't even fool with it. My investor buddies that have sold their businesses wouldn't even fool with any of this, any of the space that we live in.
Yeah, I think it depends on where you're looking within agriculture. If you look at the operating returns, there's a lot of risk that's in there, and there's a lot of years where our returns to management that Chris here at AgView talks about so much, pretty down low in a way where I could go invest in just about anything, and those index funds are going to outperform it. So if you're just looking at, if you're going to go invest and kind of go try to run a farm, just any old farm, that's not a very investable use case. However, land as an asset has both the intrinsic value, supply demand, where that goes, but also a portfolio fit that is really, really valuable, especially to a pension, an endowment, an insurance company. That's pretty darn valuable in a way that isn't for us, and that's where the capital sits, and it's around those assets today.
Okay, so it's around the real estate. Now let's go about how farm size continues to get larger, so we got these big farming operations and consolidation, scale, et cetera, et cetera. Then there's going to be a call for capital to be in that. And we've always thought, and even been told, you go to enough of these ag meetings and pay enough attention to the economics of it, big money's going to come in and control all these. Ain't going to be any small farmers. And I have increasingly the last couple of years, especially when we saw a rise in interest rates, which has started 2 to 3 years ago, right? We were essentially at almost free money for a decade, right? 2 to 3%, 4% money. You double that to 8% money. And I started saying, well, why would any big capital infusion want to be in production agriculture where you could get guaranteed returns of 5 and 6% return on a large chunk of money to get the same kind of return in production agriculture?
It's how it moves with the markets, right? It's the natural inflation protection because of the tide of commodities. Like, that's the simple mathematical answer. I mean, the other one is that, the current state that we're at right now, I mean, we saw a lot of investors pause. They moved back, just like commercial real estate was clearly overvalued. They paused, values came down. The problem in agriculture is that we have a pretty illiquid farmland market. It's stable, and you just talked about it in your presentation. There's a heck of a lot of government support, and we have a really healthy farm balance sheet. So the low risk nature, these institutions love low risk. It's a great fit in the portfolio, and so they're willing to take the bet on, whether it's climate change, whether it's other tailwinds that exist. There's a lot of money that's willing to go in and take a bet. It's a probability that they're solving. It's not a family legacy. So they're willing to bring in the money for that. And just remember, institutional or investor ownership of farmland, less than 2% in the U.S. And so we always put the investor boogeyman, and I'm someone who goes out and competes against those investors, so don't get me wrong, I got a lot of values and things against that. But those 22,000, those crazy sales, if you look at most of them, that's almost never an investor. Those are usually a couple farmers going head to head. So a lot a lot of that narrative, even though I have every incentive to
overpaying for farm ground wasn't done by BlackRock.
No.
It was done because they wouldn't.
Well, because they'd be worried about the same things you're talking about. They'd say, well, my entry price is too high. There's no way I'm going to make money on that.
Yeah. What about, and I agree, Ryan Moe, who's our MC here today, a good dude, a member of the Business Ag Success Group, says when the farmer lament is, well, these outside investors are bidding up the farm ground, he said, well, it's because it's a safe space, because as we just said, if the government throws $31 billion at this space, it generally continues to prop up the value of the held asset.
Yeah, I think you have a backstop, and I think you can look at that and know we're never going to let ag fail. We have a history of that, of making sure that we're secure, whether that be for the ag industry, the food industry, or national security.
He just said never, by the way. You're never supposed to say never. Although I actually agree with you, which is one of my points in my speech here today, because this $31 billion is just the first of, well, it's not the first. It's another one in the series of payments to go to agriculture.
Yeah.
It's an audio platform here, Brian. They don't hear you nodding your head. All right, I want to hear more about this. I want to see where you think the future goes. Before I do that, I want to remind you, if you're listening or watching this show, we're at the AgView Solutions Agricultural Executive Conference, where I just spoke today, and we heard from Ben Gordon. These guys are with a company called
Fractal agriculture.
Fractal, of course. Anyway, but I want to remind you about another company called Gripp. A company called Gripp. If you have an agricultural enterprise, you probably have a lot of proprietary information. You've got all kinds of people touching things, and there's a real good chance the stuff just gets out of hand. Are you using Post-it notes? Are you using notes? Are you talking to people that even understand what you're trying to say to them? It's time to move on. Texting, it's time for the next level. If you run a large-scale agricultural enterprise, why don't you consider Gripp, G-R-I-P-P. Basically, it's a program you put on your phone. You don't need an app. You don't need to pay for any expenses. It's a real simple deal, and you can actually use photographs. Your people can use photographs around the operation. It converts Spanish to English. It's essentially going to make your life easier to communicate what's going on in the operation. So go to Gripp and check this out. It's grip.ag. Go check it out. G-R-I-P-P, grip.ag. Check it out. A new sponsor here at the Business of Agriculture can make your life and your business run more smoothly. Where does this go? Are we in a high water point? A couple years ago, there was water just cascading into agriculture because we were, things were good. We were making lots of money, and it was this whole new thing. Oh, agriculture feels so good. Are we there? Or are we waning?
I mean, over what time horizon, right?
You keep going back to that.
Because it matters. But it doesn't just matter for the investor, it matters for the farm, right? So if you're a farmer who, you're looking to potentially retire in these next couple of years, you're making a different set of decisions than a farmer who's trying to set up that next generation, especially if there's already a plan on that. And if, depending on what you believe about where the competitiveness of your local market, what you believe agriculture is going, to the discussions we've had,
yes,
you need to operate on a different set of assumptions, or at least be ready when those different trends, either on our 1 to 2 year time horizons,
yep,
or on those 20-year time horizons go. So where do I think this goes? I think operations need to have a little bit more of that capital buffer, because we have more volatility coming economically beyond agriculture, certainly within agriculture. And then you also need to look at where there are assets that will probably only sell once every 30, 50, 75 years. And is that an asset that fits your operation that you think you can farm at an above average level or in your unique way? Well, are you going to pass up that asset because of a short-term constraint that you have when you have other options? That's the question.
Where's capital starved right now in this industry? Is there anywhere? Or is there just so much money sloshing around that it's looking for somewhere? Is there anywhere that's dying for capital in agriculture and production agriculture? In the next level, the processing level?
I don't know that space. So
I don't either.
Yeah, I think if I look at farmers, they generally have more investable opportunity. Well, not all farmers. The top quartile farmers have more ability to manage and more investable opportunities than they have capital. We've talked about government support. We've talked about farm legacies. You look at legacy balance sheets. There is not a lot of turnover. The competition has been slowed by a myriad of things about our history agriculturally. If that competition increases, then you could argue that the farm is a underfunded resource, because we have conservative lenders. The default rates are historically low. If you compare us to almost any other commodity industry,
yeah,
you're talking like 0.003% default rates.
In production agriculture?
In production agriculture.
And there's a whole bunch of people that wouldn't believe that, because, am I right, Brian? They'd say, "Oh no, I mean, a lot of farmers went broke in the old days." I don't know. That even seems low to me. I mean, I knew, because government programs have essentially continued to prop up the sector, it's not as many as the perception.
Yeah, I mean, you have a very low default rate. You have almost zero vacancy rate on non-operated land or rented land.
Yeah, you mean no. Usually, decent farm ground doesn't sit around idle.
Definitely does not.
Strip mall, there could be 20% of a strip mall that Kids R Us moved out or whatever the heck happens, but farm ground in Indiana never sits idle.
But there's a point in why there's no default. It's because lenders don't take as much risk in agriculture, or at least the main lenders who are out there don't take as much risk. And because there's a lot of stable equity, then you have a lot of folks who just kind of sit. It's not because there's not winners and losers. It's just it happens over a much longer time horizon. There's farmers that are farming and frankly losing their equity if you think about the competitiveness and the margins and where that fits. And this is where a lot of the per acre economic and the long term start to mash, because I think if we had lenders that were more aggressive, and you could argue, is that a good thing or a bad thing that we don't? I think you'd see a lot more competition. You'd see a lot more farm businesses that looked more like small, mid-sized corporations, and then you'd see a lot of the other folks kind of drop out.
One of the things you had on one of your slides was about this very thing, about how the evolution of farms happens. I'll ask you both. I'll start with Brian. I had predicted a few years ago contractual arrangements are going to increase. In other words, in my part of the world, there's a lot of hogs that get raised in Indiana, but nobody owns the hogs. Well, somebody owns them. The farmer doesn't own the hogs. They're growing them on a contractual arrangement. A vertical integrator sticks pigs on the barn that you put up with a note based on the contract, and you grow them contractually. Same with chickens. The South, whatever, eggs, chicken, pork. Why not corn and soybeans? Why will it be to a point where corn and soybeans are just growing a contractual arrangement? ADM gives me a contract to grow a certain high oleic soybean, I just grow it for them?
I don't think we'll see it. I don't think that the relationship for the farmer is there, and the incentive is there. Honestly, it's not something that I've spent a lot of time thinking about from from a value perspective? Like what's the value there for the farmer? Is there any added security there?
Yeah,
in
well,
doing it
that's
that way.
there is on these other ones. I built a barn, but you know what? I've got a contract that says that Tyson's going to stick pigs in this barn every day, and I just get paid for my pig space, and I take care of them every day, and then I get the manure to put on my field. So it eliminates the volatility for them.
Well, I think if I gave that answer to Damian Mason, I probably would ask, well, then what happens after that? I've given up all my control. I'm a captive player. And so, if you think about value to the farmer, I mean, it's variable. For certain farmers, they'd love that, right? If you want to go out and you want to drive machinery and you want to just grow crops,
Yep.
I think there's probably value, and I almost would guarantee that there will be some form of that, or at least investors will try because they think they know better. And I think even if we looked at outcome-based pricing, which was all the rage a while ago, that's not that different from what you're talking about.
Right.
Especially, we already have genetics to processor relationships that are starting to emerge or have emerged or been tried before. It's ag. Everything's been tried, right? And it's just, when does it hit? The real question is what's the competitiveness of the farmer as the operator, the decision maker, that localized decision maker versus the alternative systems. So I guarantee you we will see a model that you're almost describing. Somebody will pitch it at least. I don't know how, I agree with Brian. I don't think it's going to be viable. Someone will pitch it, and it'll probably be AI powered, identity preserved, have all these other things around it. And many of us kind of look at that with skepticism, but there might be a few things that are better than the average. And then the question is this, it's not going to beat the top quartile farmer, but does it beat the average? Does it beat the bottom quartile farmer? And then what are the implications for the market?
The other thing that you pointed out, okay, I didn't say I 100% predicted it. I said I could see it happening because it removes volatility, and there's also a lot of capital. Again, there's a lot of capital requirements. So it's the same thing. If I'm 25 and I get a chance to get a contract hog barn, it gives me some cash flow revenue, and I get manure, and it keeps me on the farm. And that might be the same thing on cropland. You got a bunch of notes written down over there. Did we get to all of them?
Oh yeah, all of them.
What about the other situation on the 2% thing? You said there's a lot of people that freak out. I just had someone send me a message on Facebook this morning. Is it true that such and such is buying all the farm ground? And Suburbia hears this. My friends in non-ag roles hear this, and I always have to say, no, it's not really true. Your numbers were there's 2% of American farm ground row crop.
Row crop, yes, sir.
Ranch land could be something different, I guess, but yeah.
I mean, who do you think the largest foreign owner of farmland is?
Canada.
Yep,
but
absolutely.
But that's not an individual. That's a country.
That's a country. Yeah.
It's companies. It's companies that derive from Canada, and most of them help me out here, Brian and Dan, Ben, are
pensions,
timber, and it's in timber ground.
Yeah, and I think Canadian pension funds.
Pension funds for land that ends up being paper or 2x4s.
Yeah, and there is significant pension, international pension, farm ownership, and a lot of European farm ownership in the U.S. But again, like if you think about just the amount of acres that we have, roughly speaking, somewhere between 45 and 50% farmer owned, and of that next 30 to 40%, most of that are either retired farmers or their next direct descendants, and then all of a sudden we start trimming it back, and it's a pretty small number.
Yeah.
That doesn't mean that investor pressure doesn't matter. It holds that floor on the market, especially in a market like Illinois or Indiana, because again, what we talked about, all that money can flow pretty rapidly if they think there's a deal.
Yep.
So that return that we are talking about, because we're so used to talking to farmers, we're used to that incremental, because farmers are almost always paying top dollar. Mm-hmm. Well, they come in that downside, and they can get that extra 2, 3, 4, 5% because they always come in on the down cycle. Mm-hmm. That's where the floor comes, and the advantage that they have is they can deploy $300 million on the down cycle, and then they don't have to deploy on the top, because they're not just buying the ground next door. They're buying anything that's a good fit.
Anything that's a good fit, and they're able to take bigger bites.
Yes.
So when there's a bigger tract that comes up, or there's a whole farm.
Yeah, when it's in my part of the world, a big tract is 300-400 acres. It's not like out west where you're buying a section, because we've had, Indiana's got a lot of population and more carved up stuff. But yeah, you'll see investors when it becomes 500, 300, 400 acres. On the other part of it about these returns, if returns improve other places, the shiny gets off of ag here pretty quickly, I think.
I think the shiny's already off ag, but allocators are used to investing in cycles. because it is pretty common practice to know. I mean, like right now, data centers are all the rage. Same thing.
You're meeting with smart enough people that already know, if we're going to do it, now would be a time. They're not the old story that in the suburbs in Phoenix where I am, when the plastic surgeon at a cocktail party starts asking me about farm ground, I'm like, oh, you just read that article in the New York Times that says that farm ground is worth a bunch of money. Yeah, when the plastic
when
surgeon
Jim Cramer talks about it, there's an issue, right? It's the same thing.
Yeah, when the plastic surgeon in Scottsdale, Arizona is drinking cocktails talking about how they should buy farm ground, is a good time the rest of us should sell.
If you want to let me know on that, where that index is at, I will incorporate that into my next fund.
Get me out of here. What do you got, Brian? Closing note. You said you've got through all your notes. Is there anything you want to tell me about this? We're talking about the big picture of capital and ag, particularly as it comes into land. You said the shiny is already off. You having a hard time right now? Do you have a harder time getting the money, or finding farmers that want to take these deals?
I think it's about being new and the industry knowing how to employ us.
Farm balance sheets are and operating revenues a little tighter.
That's right.
And obviously, things are a little tougher out here. So you got more people banging on your door that say, I want to buy this ground across the road, but I can't quite get it through a lender.
Yeah, how do I do it and stay solvent and healthy?
So in other words, right now is a better time to be you than it would have been 2 years ago when there was more flush with cash.
I think there's a different use case 2 years ago. I think there's a different value in what an equity partner brings to the table 2 years ago when you're flush with cash, because I think the farmland market is different. And I think the supply and deal flow would be different, but still a use and still a value there, because if you're the operator that is continuously looking to do more, and you have more investments to make than investable capital to put places, there's still smart investments to be made that can add value to the,
right.
to the
But
operation.
when a farm situation, like when Chris Barron's on here, and we're talking at great length about operating capital, being squeezed more now than it was 2 years ago. There's more probably acceptance or even embrace of a model like yours for the farm operator than there would have been a couple of years ago, and it's because of need.
Yeah, I think there's more need. That's both driven by farm balance sheets, but it's also driven by opportunity in the next 18 to 24 months.
And you feel good about the opportunity?
I do.
About acquisition of real estate that's a little bit beaten down on price?
Yeah, I think if you're looking at the farmland market right now, where what operators are telling me is they're seeing soft to sometimes negative. There's still, it's very locally driven. There's still
Soft to sometimes negative.
farmland valuations.
Thank you.
Class A ground, I think, is still holding, but I think that's operator propped up by, it's propped up by farmers. So if there is I think where top quartile operators are trying to position themselves right now is, do I have an opportunity in the next 18 to 24, maybe 36 months to make some investment decisions into my business that I'm not going to get so hyperbolic to say it's going to change the tract of my farm for the
Yep.
next generation, but it's certainly going to have value that you wouldn't have been able to add, say, 2 years ago.
So I know you got investors, Ben. When you talk about who are you going to? Who's your next call after this?
Given where we're at, it's going to be talking to a bunch of farmers. But for us,
And you got actual farmers that are your investors too?
Retired. Well, I actually typically I've had several farmers say, "Hey, we want to invest in Fractal in the fund," and they all start then saying, "Hey, I want to do an investment with you." And my response to them is, "Let's not pay any fees, and let's just make sure you're using their capital." So I don't tell farmers what to do. I don't want to be paternalistic, but if you're going to take capital from us, you shouldn't give us capital too.
Yeah.
But I think when I look for us, and especially coming out of a week like this, where you see the level of operator and the way that they're thinking that we've had the chance to work with, both well before this conference, but you're talking to the people here, you can't tell me that there aren't opportunities that these folks are going to find that are good investments if you have any bullishness about the future of American agriculture. And I guess I believe, and I'm guessing you do too, that the next 5, 10, 20 years is going to look a lot different. And the folks that are ready to seize that opportunity are going to need capital, but they're going to seize that opportunity and do well. And so for us, we're often investing not when you absolutely need it. We're being proactive. We're building relationships. They're storing dry powder because they don't know what the future holds. They're looking for downside protection because if land comes down, we go down with them. That's part of the value of this, of being a partner and having that symmetry. And frankly, we talked a lot at the beginning of this about other industries. Pretty much any other darn capital-intensive commodity industry has equity capital. Why the heck do our farmers not?
And that's where you came in. You part owner of this?
Yes, sir.
That's good. Brian, you part owner of this?
Yes, sir.
I like it. How many owners are there?
Well, every one of our employees has ownership because
Okay.
that's really, really important. We founded this along with our co-founder, Emma. We went to business school together, so been working on this or thinking about this for a long time, but I think the timing's right if you think about the broader market and the opportunity that our farmers have.
I think it is. Thanks for talking to me about capital, talking about farm ground. This is something that we talk about a little bit here, but you know what? We cover a lot of business topics here at the Business of Agriculture, so we very much appreciate you tuning in. If you are listening, remember you can watch it on YouTube. While you're on YouTube, please hit subscribe for the Damian Mason channel. It doesn't cost you anything. You can also check it out on Acres TV. If you do enjoy watching and listening to my stuff, please check out my new show, The Granary. It's shot at my on-farm tavern in Huntington, Indiana with my friends from Extreme Ag. It's just farm guys sitting around talking about cool stuff that happens, the personal, the private, the professional, the intimate, the authentic. It's the real thing. So, check it out. It's called The Granary. You can find it at extremeag.farm, or you can go to YouTube and go to the Extreme Ag channel there and check it out. Till next time, thanks for being here. His name is Ben Gordon. He's joined by Brian Grundtner. If you want to learn more about the company that they founded, it's called Fractal. Where do they find it?
Fractal, Fractal.ag, A-G.
Got it. Till next time, thanks for being here. And this is, as ever, I'm Damian Mason, the Business of Agriculture. Are you an agricultural company looking to reach farmers and ranchers eager for your products and services? Look no further than Agvisor Pro. This innovative platform creates instantaneous connections between businesses and farmers who are interested in what you have to offer. By partnering with Agvisor Pro, you can engage directly with a targeted audience, answer questions in real time, and showcase your expertise in the industry. Don't miss this opportunity to grow your brand and connect with engaged customers. Join Agvisor Pro today, where farmers meet trusted companies just like yours in an instant. To learn more about partnering with Agvisor Pro to enhance your business, email them info@agvisorpro.com. That's info@agvisorpro.com.